Silver just did something that has not happened in decades. Not a small move, not a minor fluctuation, a shift so sudden, but so aggressive, that traders across Wall Street stopped what they were doing to watch it unfold in real time. Because this wasn't random. This was a signal tied to a weakening job market, a shifting Federal Reserve, and a government suddenly treating raw metal like a matter of national security. Somewhere between a stunned Wall Street and a closed-door meeting in Washington, silver quietly became the center of a much bigger story. And by the end of this video, you will understand exactly why and what it could mean for your money in the months ahead. Welcome back to Precious Metals Intelligence, a channel built for those who prefer to understand markets rather than simply react to them. If you value clear analysis over noise, you are exactly where you should be. Before we begin, it would be a pleasure to know, where are you watching from today? Feel free to share your city or country in the comments below. This community spans the globe, and it is always meaningful to see just how far these conversations reach. On a quiet Friday morning, something happened that most people never expected. The United States released its monthly jobs report, and the numbers were bad. Not slightly bad, not a small miss. The economy added far fewer jobs than experts had predicted. Analysts were expecting strong growth. Instead, they got a sharp decline. For most people, this kind of news might seem boring. Just another economic report, just another number on a screen. But for traders, investors, and financial institutions around the world, this was not boring at all. This was a shock. Within minutes, the reaction began. The US dollar started to fall. Treasury yields, which are closely watched by every serious investor, dropped as well. And gold, one of the oldest forms of protection against economic trouble, jumped to its highest level in 7 weeks. This is where it gets interesting. In the world of finance, bad news about the economy often means good news for precious metals. It sounds strange at first, but the logic is simple. When the economy weakens, the Federal Reserve becomes less likely to raise interest rates. Sometimes it may even consider cutting them. Lower interest rates make it less attractive to hold cash or bonds, because those options no longer offer the same returns. So investors look elsewhere. They look toward assets that hold their value even when the economy is struggling. Gold and silver are two of the oldest choices for this purpose. This is why, within hours of the jobs report, money began moving. Big financial institutions, hedge funds, and everyday investors all reacted almost at the same time. Nobody wanted to be caught on the wrong side of a fast-moving market. But something else was happening at the very same time. Something that made this moment even more important. Just one day earlier, silver had been trading at a much lower price. It was steady, it was calm, nothing about it looked dramatic. Then, within a matter of hours after the jobs report, silver shot upward with incredible speed. It did not creep higher slowly, it surged. Traders who were watching their screens described the movement as one of the fastest they had seen in years. This sudden jump did not happen by accident. It was the direct result of the shock coming from the jobs report, combined with a market that was already sensitive to any sign of economic weakness. When traders saw the dollar falling and yields dropping, they moved quickly into precious metals. Silver, already known for moving faster and more sharply than gold, reacted the strongest. For someone who does not follow markets closely, this may all sound technical, but the core idea is simple and it matters to everyone, not just professional traders. When the economy shows signs of weakness, money starts searching for safety. And in recent years, more and more of that money has been finding its way into silver. What makes this moment different from past silver rallies is the speed at which it happened. Markets can take weeks or even months to build momentum. This time, it happened in hours. That kind of speed usually signals something deeper than a simple reaction to one report. It often means that many different forces were building quietly in the background, waiting for the right moment to be triggered. And that is exactly what experts began to suspect. This was not just about one disappointing jobs report. This was about a market that had been building pressure for weeks and finally found its breaking point. By the end of that single trading day, silver had moved by an amount that would normally take much longer to happen. Analysts across Wall Street took notice. Financial news outlets began asking the same question. Was this a short-term reaction, or was this the beginning of something much bigger? For business professionals and serious investors, this question matters. A single day's move can sometimes fade quickly. But when a move this large happens alongside major shifts in the dollar, interest rate expectations, and investor behavior, it often points to a bigger story developing underneath the surface. And that is exactly what was happening. Because while the jobs report explained the timing, it did not explain everything. Behind this sudden explosion in silver, deeper forces were already in motion. Forces tied to how professional traders were positioned before this moment even began. To understand why this rally had so much power behind it, it becomes necessary to look closer at what was happening just beneath the surface of the silver market in the days leading up to this event. Numbers rarely lie. And the numbers behind this silver rally told a story that many traders had missed completely. Weeks before the jobs report ever hit the wires, something unusual was already forming inside the silver market. It was quiet. It was not making headlines, but it was there, sitting in the background like a coiled spring waiting for a reason to release. That reason came from positioning data. In financial markets, positioning refers to how much money large traders and institutions have already committed to a certain direction. When positioning is heavy, a market tends to move slowly because most of the big players have already made their bets. But when positioning is light, the opposite can happen. A market becomes vulnerable to sudden, sharp movement because there is room for new money to rush in all at once. According to data reviewed by major financial analysts, silver entered this period with unusually light positioning. In simple terms, large speculative traders were not heavily invested in silver going up. Their exposure was sitting near the bottom of its normal range over the past 2 years. This meant the market had very little resistance if a strong wave of buying suddenly appeared. And that is exactly what happened. When the jobs report shocked the market and the dollar began to weaken, silver did not just rise. It rose into a market that had almost no one prepared for it. There were not enough sellers holding firm positions to slow the movement down. As new buyers rushed in, prices moved higher with very little to stop them. This is one of the most important ideas for any serious investor to understand. Markets do not always move based on how important the news is. Sometimes they move based on how ready or unready the market was before the news arrived. A moderately important piece of news can cause an enormous reaction if it hits a market that was already fragile and thin. That is precisely what analysts believe happened with silver. As the day progressed, trading data showed something else worth noting. The total amount of open contracts in silver, a measure known as open interest, increased sharply. This told analysts that new money was entering the market, not just existing positions being closed out. In other words, this was not simply short sellers giving up. This was fresh buying, adding real weight behind the rally. Some of the largest increases in buying happened near the highest points of the day's price range. This detail matters. It suggests that traders were not hesitant or cautious. They were confident enough to keep buying, even as prices climbed higher and higher, a sign that conviction behind the move was strong, not fading. For someone unfamiliar with financial markets, this may sound like a technical detail. But think of it this way. Imagine a narrow hallway with only a few people standing in it. If a large crowd suddenly tries to enter from one direction, there's very little room to absorb that crowd calmly. People get pushed forward quickly, with force. That is very similar to what happened inside the silver market. The hallway of the market was mostly empty when the crowd arrived. This explains why silver moved so much faster and with far more intensity than gold did on the very same day. Gold also rose, and it reached a multi-week high, but its movement remained more controlled. Silver's smaller and thinner market meant that even a moderate wave of new buying could cause a much larger price swing. For business professionals and long-term investors, this pattern raises an important question. If the market was this unprepared for a single day's news, what happens if more unexpected events follow? What happens if the pressure does not fade, but instead continues to build? Analysts covering the metals market began asking the very same question, because thin positioning does not just explain what already happened. It also creates the conditions for something even larger to happen next. If traders who were betting against silver, expecting its price to fall, suddenly found themselves on the wrong side of this move, they would eventually be forced to take action. And that action carries a name well known throughout financial markets: a short squeeze. It is a moment where fear, not opportunity, begins driving the price. What that means, and why it could push silver even further, is where the story goes next. There is a moment in every fast-moving market where confidence turns into fear. For silver, that moment may have already begun. To understand why, it helps to first understand what a short squeeze actually is. When a trader believes a price will fall, they can borrow the asset and sell it, planning to buy it back later at a lower price. This is called short selling. It can be profitable when the trader is right, but when the price moves in the opposite direction instead, the trader faces a growing loss. And unlike an investor who simply bought and can wait patiently, a short seller cannot wait forever. At some point, they are forced to buy back what they borrowed, no matter the price, simply to stop the bleeding. When many traders are forced to do this at the same time, it creates a wave of buying that has nothing to do with belief in the asset. It has everything to do with survival. This wave can push prices higher at a speed that shocks even experienced professionals. This is what analysts mean when they warn of a short squeeze. Major financial institutions have already pointed to this exact risk in silver. According to warnings reported from firms such as Goldman Sachs, the conditions were already in place for this kind of event. Remember the earlier point about thin positioning. When speculative buyers were mostly absent from the market, some traders felt confident enough to bet against silver, assuming prices would stay low or fall further. That assumption became dangerous the moment prices reversed sharply upward. For these traders, every dollar silver moved higher meant real financial pain. and the higher it moved, the more pressure built on them to exit their positions. This is why some analysts believe the rally seen so far may only be the beginning, not the end. If enough short sellers are forced to buy back their positions at the same time, the resulting demand could push silver even higher than the initial surge caused by the jobs report alone. This is a critical point for any serious observer of financial markets. A short squeeze does not require new economic news to keep going. It can feed on itself. Fear replaces analysis, survival replaces strategy, and prices can move in ways that seem disconnected from any single headline. However, there is another side to this story that deserves equal attention. While the paper market, meaning futures contracts and speculative trading, was moving with incredible speed, the physical silver market was telling a slightly different story. Physical silver refers to the actual metal itself, the kind held in bars, coins, and industrial supply chains, rather than contracts traded on a screen. Analysts studying silver lease rates, which reflect how tightly supply is held in the physical market, noted that these rates had softened during the rally. In simple terms, this means the physical market was not showing the same level of urgency or tightness that the price surge in paper markets might suggest. This creates an important and somewhat uncomfortable question for investors. Is this rally being driven mainly by financial trading activity, speculation, and forced buying from short sellers? Or is it also being supported by real physical demand for the metal itself? Experienced analysts describe this gap as one of the more delicate aspects of the current situation. A rally driven purely by paper trading and short covering can be powerful, but it can also reverse quickly once the forced buying is complete. A rally supported by strong physical demand tends to be more durable because it reflects real-world need, not just financial pressure. At this stage, the evidence suggests a mix of both forces. The speculative and short squeeze pressure appears to be real and significant, based on positioning data and institutional warnings. Yet the physical market has not yet fully confirmed the same level of urgency. For someone trying to make sense of this as a long-term thinker rather than a short-term trader, this distinction matters greatly. It is one thing to witness an explosive price move. It is another thing entirely to understand whether that move is built on a strong foundation or a temporary imbalance. What is becoming increasingly clear, however, is that silver is no longer moving simply because of investor sentiment or economic data alone. Something bigger is beginning to take shape, something connected not just to trading desks and hedge funds, but to decisions being made at the highest levels of government. And that shift, quietly unfolding in Washington, may be the most important part of this entire story. While traders were watching charts and price screens, something else was happening in Washington that received far less attention, yet may carry even greater long-term significance. On the very same day silver was making its dramatic move, a large gathering was taking place inside the State Department. Roughly 200 mining executives and government officials came together for a single purpose. They were there to discuss the future of America's critical mineral supply chains. For most people outside the world of industry and policy, the phrase critical minerals may not sound particularly urgent, but for those who understand how modern economies and modern militaries function, few topics carry more weight. Critical minerals include materials like silver, along with several other metals that are essential to manufacturing, technology, and national defense. These are not simply materials used to make jewelry or coins. They are used in electronics, in solar technology, in advanced military equipment, and in countless industrial applications that keep a modern economy running. For decades, the United States, like many other nations, relied heavily on foreign countries, especially China, for large portions of its mineral supply chain. This worked well during periods of global cooperation and stable trade relationships. But global conditions have changed. Tensions between major powers have increased. Supply chains that once seemed reliable are now viewed as vulnerabilities. This is the backdrop that brought together mining executives and senior officials, including figures such as Secretary of State Marco Rubio, for this high-level meeting. Their goal was direct and serious: reduce dependence on foreign sources, rebuild domestic production, secure the materials needed not just for economic stability, but for national defense. One detail mentioned in connection with this meeting stands out in particular. Part of the discussion focused on replenishing military resources used during recent conflicts, including materials connected to weapon systems used during tensions involving Iran. This detail shifts the conversation about silver away from pure investment talk and into the realm of national security planning. When a government begins treating a material as essential to its defense capabilities, its importance can no longer be measured only through investment charts and trading patterns. It becomes tied to policy decisions, strategic stockpiling, and long-term planning that operates on a completely different timeline than daily market speculation. This is where the story becomes especially important for business professionals and long-term thinkers. Markets driven purely by speculation can rise and fall quickly, but markets influenced by national security policy tend to follow a much longer and more determined path. Governments do not make decisions about supply chain independence casually, and they do not reverse those decisions quickly once they are set in motion. The timing of this meeting, occurring on the exact same day silver experienced its historic price surge, did not go unnoticed by analysts covering both financial markets and geopolitical developments. Some described it as coincidence. Others viewed it as a signal that decision makers were already aware of tightening supply conditions and were taking steps to respond before the situation became more difficult to manage. Whether coincidence or coordinated timing, the message being sent was the same. Silver is no longer simply a financial asset traded by investors seeking short-term profit. It is increasingly being viewed as a strategic resource, essential to defense systems, technology infrastructure, and national resilience. This shift changes the nature of the conversation entirely. A material tied to national security tends to attract different kinds of attention. Governments may implement policies to secure supply. Domestic production may be encouraged through incentives or funding. Stockpiling may increase, not just from private investors, but from government agencies themselves. For someone trying to understand where this story is heading, this development adds a layer of seriousness that goes far beyond a single day's trading activity. A price surge driven by a jobs report can fade with the next economic report. A strategic shift in how a government views a resource tends to unfold over months and years, not hours and days. And when financial market pressure and government strategic interest begin moving in the same direction at the same time, that combination rarely stays quiet for long. What this could mean for the months ahead, and how everyday investors and business professionals should think about this shifting landscape, is where this story reaches its conclusion.